Hello, Avila Finance students. I'm looking forward to working with you this fall into the early winter. Anyway, I'm Joe Barnhill, be your instructor for the next 8 weeks. And hello again for those that I've been in maybe one of my economics course, and welcome those that are new to my course. So with finance, this week, definitely jump into the course, look around. You'll notice it's arranged by modules. This week we look at chapters 1 and 2. And it's really important to jump into those forum discussions right away. This is a large group, so I try to respond back to as many people as I can, especially if you jump in earlier in the week. I'm more likely to be able to respond to your post, but have that initial post completed by Wednesday by midnight. And what I'll be doing is I'll be doing one of these video mini lectures every week. Usually the video mini lectures are just about 6 minutes in length, just kind of give you an overview and insights into the week. But also with this past week, Richard Thaler won the Nobel Prize in economics. And if you ever seen the movie The Big Short, he's actually sitting at a table with Selena Gomez talking a little bit about the hot hand theory. And it ties in so well to our discussion about markets. And even one of the principles that we look at this week is that we're making assumption that markets are efficient. And it also talks about the subprime crisis that happened about 10 years ago. And some people question, whether investors were really rational with their decisions. So it's still something of debate. But in this course, we focus mostly on the academics and the principles, and you'll learn a lot as you go along. Starting off in that chapter 1, talk about some of those key principles in finance. First, that cash flows are important, especially incremental cash flows. Accountants can do anything to manipulate books, but really how much cash is coming in. Also, that money has time value to it, so there are opportunity costs. We take on risk, we expect a higher reward. It doesn't mean that we're going to get that reward, but we're going to help us when we start to look at things like weighted average cost of capital and net present value later in this course. Also, that we're assuming that markets are efficient. Efficient market hypothesis came from Eugene Fama out of University of Chicago, also where Richard Thaler is, so they have a lot of prominent economists and finance people that come out of that school. But we'll learn more about that theory, but it's kind of saying that at any given price, any given time, or any stock or any asset, it should be accurately reflected in the price in the market. That information is available. And then also there are conflicts of interest that can happen in finance. So we have what we call principal agent problem. We hire managers to be the agents. As shareholders, we own shares in the companies. We are principal holders. And we have to be careful to watch those that are the managers that are making the best decisions. Especially in controversy recently. I can think about some things. I think there was one with Japanese steel recently, and Japan's kind of getting hit up lately about some bad news. I think one was with airbags recently. So the big thing these days, executives, and if they make bad decisions or are lying or do anything like that, that could almost have like a 30% decline in a stock valuation, just because people don't trust them anymore. So, ethics is important and ties to finance. Some other things too, kind of wrap up with this chapter. It talked about the subprime crisis, how that still just plays such an important role in our markets today. Kind of a constant balance between what I would call regulation versus free markets. So we have to make sure there's enough in place. And with that, with any internal organization, we talked about the CFO and their responsibility. Usually it's kind of breakdown between the treasury side and what I call the controller side. The controller side works more on the accounting, the reporting, make sure the books are good. The treasurer side is a lot of my background. I used to be a certified cash manager, and you're basically making sure that you have enough short-term cash, your banking relationships, and also long-term, and that's when we get into the capital markets. And that's kind of when we get into chapter 2. It talks about the different ways that companies can raise capital, basically raising money. Is that done through stocks? Is it done through a bank loan? Is it done through corporate bonds? All kinds of different variety of securities out there. And for big corporations, Fortune 500 corporations, they'll work a lot, even smaller ones too, but they will work with what I would call the underwriters, the Wall Street firms, and the Wall Street firms will do their due diligence if it's an initial public offering to try to figure out what the ideal price should be issued at that is fair in the market, and then they will come upon an agreement. There's a spread that the investment banker gets, and that's where they make a lot of money, and they do it on the selling the stock on a best efforts basis or sort of full commitment. So ideally, if you're a corporation, you want a full commitment because you get the guarantee of that money, and then it's the responsibility of the investment bank to sell those shares or sell those bonds. So a lot of that chapter 2 begins off with that. Talks about some different definitions between, primary market, secondary. Most of us hear in the news about the secondary market, but primary is when it first is originally issued. Money markets are anything that is matures in 1 year or less. This could be CDs, treasury bills, repurchase agreements. Capital markets, we typically think of anything that is long-term, being more than a year, a stock, a bond, other types of securities that will last a long time. And they also talked about the difference between the spot market, what is the price now, and futures, what might it be in the, later. And companies use derivatives sometimes, and there's large derivative markets to help companies hedge or to provide opportunities for other financial situations. With this kind of last part, they wrap up was the discussion of the interest rates, comparison of interest rates to different time periods, to different types of securities. Those are more risk-free versus those that take on more risk. Obviously, you have what's called a nominal rate, the actual stated rate. But within that, we typically think of like what might be included as a risk-free rate. Like a treasury bill would be a risk-free rate because the government can guarantee the backing, no other institution can. But there's factors such as liquidity premium, inflation premium, default premium. All of these things factor into what is that stated interest rate. And the last part of chapter 2, they look at the yield curve. And generally we see an upward slope in yield curve. That is, the longer we go out in period of time, that we would expect higher interest rates, but sometimes that yield curve could be inverted or shaped different ways. The textbook mentioned different theories behind this shape. The expectations theory, I should be indifferent maybe between buying 2 1-year securities, waiting a year and buy another 1 year versus a 2-year. So I could read into that 2-year to see what the expectations are 1 year from now. Also, we have what's called liquidity theory, that the longer you wait, the longer it will be compensated for it. Just like if you took out a 1-year CD versus a 5-year CD, you expect a higher return in that 5-year CD. And finally, the market segmentation that says, hey, there's short-term lenders, short-term borrowers. There's long-term lenders, long-term borrowers, and each have different supply and demand curves in those markets that establish the interest rates as the price in those markets. So, well, that gives you a general overview. So definitely jump in there, form discussion early, get your readings done. Again, a key is available in the course for the homework problems. Big thing about the homework, how I grade them, I grade it on quality and effort. So you can check your answer to the key, but you really need to show me the work. If you don't show me the work and you just put the answer down, you're not going to receive full credit and points. So again, do email me. That's the best way to get hold of me if you have any questions. I'll check the course daily, try to get back to you that day or the following day. But have a great week, and I will talk to you online.